Something shifted in the last 72 hours, not in the headlines, not on social media, but in the quiet machinery that moves markets. If you hold silver, or if you've been watching it from the sidelines, the next few days represent a decision point. Not because of panic, not because of hype, but because structural forces that have been building for years are now converging in ways that demand your attention. I'm not here to sell you fear. I'm here to walk you through what's happening with clarity and precision. Because whether you profit from this moment or miss it entirely depends on how well you understand the mechanics underneath the noise. This isn't about price predictions. It's about pattern recognition. And right now, the patterns matter more than they have in over a decade. Let's begin with what most people are missing. For months, silver has been moving in a way that contradicts surface-level analysis. While mainstream financial media focused on equities and speculative assets, something unusual was occurring in the industrial metals space. Institutional accumulation has been steady, not frantic, not headline-grabbing, just consistent, deliberate positioning by entities that move billions, not thousands. This tells us something important. Smart money doesn't accumulate during euphoria. It accumulates during distraction. And for the past 18 months, retail investors have been distracted by everything except the monetary metals. Now, here's where it gets interesting. We're seeing a convergence of three critical factors that historically precede major repricing events in silver. First, physical supply constraints are tightening. Production hasn't kept pace with industrial demand growth, particularly in solar, electronics, and battery technology. Unlike speculation, industrial demand is structural. It doesn't disappear when sentiment shifts. Second, the relationship between silver and gold, the gold to silver ratio, is sitting at levels that have preceded significant silver rallies 5 times in the last 40 years. When gold pulls away from silver for extended periods, reversion eventually occurs. It's not a guarantee. It's a probability based on historical market behavior. Third, and this is crucial, currency debasement concerns are no longer fringe discussions. Central banks globally have expanded money supply at rates that would have seemed impossible a decade ago. When fiat currencies lose purchasing power, hard assets historically absorb that lost value. This isn't theory. This is pattern recognition across centuries of monetary history. But here's what makes the next 72 hours particularly important. Let's talk about the landscape we're actually operating in. Not the one portrayed in 30-second news clips, but the real structural dynamics. Global debt has exceeded $300 trillion. That's not a typo. $300 trillion. This debt exists in an environment where interest rates, despite recent increases, remain historically accommodative when adjusted for real inflation. What does this mean in practical terms? It means the cost of servicing that debt is manageable only if rates stay contained. But inflation creates pressure for rates to rise, and rising rates make that debt burden increasingly unstable. Governments face an impossible choice. Control inflation through aggressive rate increases and risk debt crisis, or allow inflation to persist and watch purchasing power erode. History shows us they consistently choose the latter. Silver sits at the intersection of this dilemma. It's an industrial metal sensitive to economic activity, but it's also a monetary metal, responsive to currency debasement concerns. This dual nature creates unique dynamics. When industrial demand holds steady while monetary anxiety increases, silver receives support from both sides. And right now, both conditions are present. Manufacturing activity in key sectors remains robust. Solar panel production alone requires substantial silver supply. Electronics manufacturing continues expanding in developing markets. These aren't speculative demands. They're structural requirements of modern technology. Simultaneously, inflation concerns haven't disappeared. They've simply moved out of daily headlines. But actual inflation, the loss of purchasing power ordinary people experience, remains elevated in most developed economies. Food costs, energy costs, housing costs. These haven't returned to pre-2020 levels. They've stabilized at higher plateaus. This is what real inflation looks like. Not the monthly rate changes reported in headlines, but the accumulated loss of purchasing power over time. When people lose faith in the stability of their currency's purchasing power, they seek alternatives. Gold has historically been the primary alternative. Silver, with its lower entry price and dual industrial demand, often follows with higher volatility. Now, let's address the cycle we're in. Markets move in cycles. This isn't mysticism. It's crowd psychology meeting supply and demand dynamics. And every cycle has phases: accumulation, markup, distribution, and decline. For the past 18 months, silver has been in what technical analysts call a re-accumulation phase. Prices consolidate, retail interest wanes, smart money positions quietly. Then, when structural catalysts align, the markup phase begins. We appear to be at that transition point. Not because of one data point, but because multiple independent indicators are aligning simultaneously. Investor psychology right now is skeptical. That's actually a positive indicator. Market tops form during euphoria, when everyone believes prices can only go higher. Market bottoms form during skepticism, when everyone believes the opportunity has passed. If you're feeling uncertain right now, you're not alone. That uncertainty is precisely what creates opportunity for those who understand the underlying mechanics. There's a fundamental misunderstanding about how silver moves. People expect it to behave like a stable investment, steadily appreciating over time. That's not silver's nature. Silver is volatile, deeply volatile. It makes dramatic moves in short periods, then consolidates for extended periods. If you're expecting smooth, predictable returns, you're looking at the wrong asset. This volatility scares most retail investors away. But it's precisely this volatility that creates the opportunity. Assets that move smoothly and predictably don't generate substantial returns. They're priced efficiently because everyone understands them. Silver's inefficiency, its tendency to be undervalued for long periods, then repriced dramatically, is what creates its potential. Another misunderstanding involves the comparison to gold. Many people view silver as poor man's gold, a cheaper alternative without understanding the distinct dynamics. Gold is primarily a monetary metal. Its industrial use is minimal. It's valued for its history as money and its role as a store of value during currency instability. Silver is both monetary and industrial. This creates complexity, but also opportunity. When monetary concerns rise, silver benefits. When industrial demand increases, silver benefits. When both occur simultaneously, silver can significantly outperform gold. The gold to silver ratio measures how many ounces of silver equal 1 ounce of gold. Historically, this ratio has averaged between 50 and 60 to 1. Recently, it's been above 70 to 1 for extended periods. What does this mean? It means silver is historically undervalued relative to gold. When this ratio reverts, and historically it always reverts, silver makes substantial moves in short time frames. But reversion isn't guaranteed in any specific time frame. This is crucial to understand. Markets can remain inefficient longer than most investors can remain patient. That's why this moment matters. We're seeing multiple catalysts converging simultaneously, increasing the probability of near-term repricing. People also misunderstand the relationship between paper silver and physical silver. Most silver trading occurs in paper markets, futures contracts, ETFs, derivatives. Physical silver is a small fraction of total trading volume. This creates a dynamic where paper markets can suppress price discovery in the short term. But physical supply constraints eventually force repricing. When industrial users need actual metal, paper contracts don't satisfy that demand. We're approaching a point where physical market dynamics may overwhelm paper market suppression. This doesn't happen often, but when it does, moves are dramatic. Let's look at history without cherry-picking data. In 1979, silver moved from around $5 per ounce to nearly $50 in 16 months. That's a tenfold increase in just over a year. In 2011, silver again reached nearly $50 per ounce, rising from around $17 18 months earlier. That's roughly a threefold increase. What preceded these moves? Extended periods of consolidation, currency instability concerns, and negative real interest rates. Sound familiar? Now, I'm not predicting silver will reach $50 in the next year. Predictions are guesses. What I'm showing you is that silver has historically made dramatic moves when specific conditions align. Those conditions are present today. That doesn't guarantee the same outcome, but it increases probability. Between these major moves, silver spent years consolidating. From 1980 to 2003, it mostly traded between $4 and $7. From 2013 to 2020, it mostly traded between $14 and $18. If you bought silver in 1980 and held through 2003, you lost purchasing power. If you bought in 2011 and sold in 2020, you lost money. Timing and patience matter enormously with silver. This is why understanding cycles is more important than chasing price movements. If you enter silver during euphoria, you'll likely be disappointed. If you enter during skepticism with a long-term perspective, history suggests you'll be rewarded. Right now, we're not in euphoria. Most retail investors aren't talking about silver. Financial media isn't running daily silver coverage. Social media isn't flooded with silver hype. This is what opportunity looks like. Not exciting, not headline grabbing, just quietly compelling for those paying attention. If you already hold silver, the next 72 hours don't require action. They require patience and perspective. You've already made the difficult decision to allocate capital to a volatile, misunderstood asset. That took conviction. But don't abandon that conviction because of short-term price movements in either direction. If silver moves substantially higher in coming days or weeks, resist the urge to sell everything immediately. Major moves in silver tend to extend further than most people expect. The psychology that drove you to buy silver, concern about currency stability, desire for hard asset exposure, recognition of supply constraints, doesn't disappear when price increases. Consider having an exit strategy, but make it rational, not emotional. Perhaps you sell a portion at certain price levels to recover your initial investment. Perhaps you hold long-term as portfolio insurance, but make these decisions based on your financial situation and goals. not fear of missing out or fear of losing gains. If silver moves lower in the short term, understand that volatility works in both directions. A pullback doesn't invalidate the structural thesis. It's simply market noise. If the reasons you bought silver remain valid, short-term price movements are opportunities to add, not reasons to panic. The worst thing current holders can do is sell during fear and buy during euphoria. That's how most retail investors lose money in volatile assets. Your advantage as someone who already holds silver is that you've already entered. You're not trying to time the perfect entry. You're managing a position through cycles. Review your allocation. If silver represents too much of your portfolio, say more than 10 to 15% for most investors, consider whether you're comfortable with that volatility. If it's causing you to lose sleep, you may be overexposed. If it represents a small portion of your portfolio, the volatility shouldn't concern you. This is precisely why we diversify, so that movements in individual assets don't dictate our emotional state. If you don't currently hold silver, the question isn't whether to buy in the next 72 hours. The question is whether silver fits your financial situation and risk tolerance. Let me be direct. Silver is not for everyone. If you need money in the next 12 months, silver is inappropriate. If you can't tolerate 30% drawdowns, silver is inappropriate. If you're seeking stable, predictable returns, silver is inappropriate. Silver is for a portion of a diversified portfolio, held by investors who understand volatility and think in terms of years, not weeks. If those conditions fit you, current positioning appears favorable from a probability standpoint. Not guaranteed. Favorable. Entry timing in silver is less important than most people think. Yes, entering at $28 is better than entering at $32. But if silver ultimately moves to $45 over the next 2 years, the difference between 28 and 32 becomes noise. The bigger mistake is paralysis, waiting for the perfect entry that never comes while the structural move unfolds without you. Consider dollar cost averaging. Rather than trying to time one perfect entry, commit to purchasing a set amount monthly over 6 to 12 months. This removes emotion from the equation and averages your entry price across different market conditions. For physical silver, understand the premiums above spot price. Dealers charge more for physical coins and bars than paper silver trades for. This is normal. Factor it into your decision. Physical silver provides true ownership without counterparty risk, but it's less liquid and has storage considerations. Paper silver through ETFs is more liquid, but introduces counterparty risk. Neither is wrong. They serve different purposes. Many investors hold both. Also understand that silver won't move smoothly upward. There will be days or weeks where it drops 10%. There will be false starts. There will be moments where you question your decision. This is normal. It's part of holding volatile assets. If you can't handle that psychologically, reconsider your allocation size or your involvement entirely. But if you can maintain perspective, if you understand that volatility is the price you pay for potential outperformance, then current conditions present a reasonable entry point based on historical patterns and structural dynamics. Let's talk about the mistakes that destroy wealth during volatile periods. These aren't theoretical. These are patterns I've watched repeated countless times across different assets and cycles. First, do not use leverage. Buying silver on margin or through leveraged instruments might seem attractive when you believe price will rise. But silver's volatility will liquidate leveraged positions during normal market fluctuations. Many people have been right about silver's long-term direction, but still lost money because leverage forced them out during temporary pullbacks. Don't be that person. Second, do not invest money you need. This should be obvious, but emotion overrides logic during market excitement. If you need funds for living expenses, debt payments, or near-term obligations, those funds don't belong in silver regardless of how compelling the opportunity appears. Third, do not follow social media hype blindly. You'll see posts claiming silver will reach $100 by next month. You'll see conspiracy theories about manipulation and suppression. Some of this contains kernels of truth wrapped in sensationalism. Filter everything through logic. Does the claim make structural sense? Can you verify the information independently? Or is it designed to generate clicks and emotional response? Fourth, do not abandon your broader financial plan. Silver might be compelling right now, but it's one component of a comprehensive strategy that includes emergency funds, retirement accounts, debt management, and appropriate insurance coverage. Chasing silver while neglecting foundational financial health is backwards. Build the foundation first, then add strategic positions like silver. Fifth, do not panic sell during volatility. If you've done your analysis and committed capital to silver, short-term price movements shouldn't change your thesis. Unless fundamental conditions change, price volatility is noise. The people who lose money in volatile assets are those who sell during fear and buy during euphoria. Discipline means doing the opposite of what feels comfortable. Finally, do not expect silver to solve every financial challenge. It's not a get-rich-quick scheme. It's not a guaranteed return. It's a strategic allocation within a diversified portfolio. held by patient investors who understand market cycles. If you approach it any other way, you're setting yourself up for disappointment and poor decision making. Step back from silver specifically and look at the broader financial landscape we're navigating. We're living through a period of monetary experimentation unprecedented in modern history. Central banks have expanded balance sheets to levels that would have been inconceivable 20 years ago. Government debt continues growing with no realistic path to reduction. This isn't political commentary, it's mathematical reality. When debt grows faster than the economy, eventually something adjusts. Either the debt is defaulted on, which is politically untenable, or the currency is devalued, which happens gradually and is less visible. History shows us that governments consistently choose gradual currency devaluation over explicit default. This means your purchasing power erodes over time, even if nominal prices of some goods stay stable. Hard assets, real estate, commodities, precious metals, tend to maintain purchasing power during currency debasement. They're not perfect hedges, nothing is, but they're imperfect hedges, which is better than no hedge at all. Silver represents one tool in a broader strategy of protecting purchasing power while maintaining optionality for growth. Interest rates remain historically low when adjusted for real inflation. This means cash loses purchasing power while sitting in savings accounts. Bonds offer minimal real returns. Equities are priced at elevated valuations by historical standards. This environment creates challenges for conservative investors seeking safety and growth. There are no risk-free returns anymore. Every allocation involves trade-offs. Silver's trade-off is clear. You accept volatility and uncertainty in exchange for potential purchasing power protection and appreciation during specific market conditions. Understanding this trade-off is crucial. If you expect silver to behave like bonds, stable, predictable, boring, you'll be perpetually disappointed. If you understand silver's nature and allocate accordingly, you can benefit from its unique characteristics. Successful investing in volatile assets comes down to emotional control more than intelligence or information. You can have perfect analysis, understand every structural dynamic, recognize the opportunity clearly, and still lose money if you can't control your emotional responses to price movements. Fear and greed are hardwired into human psychology. They served our ancestors well when deciding whether to run from predators. They serve us poorly when making financial decisions. When silver rises rapidly, greed whispers that you should invest everything because you'll miss out on life-changing gains. When silver falls, fear screams that you should sell everything because it's going to zero. Both emotions lie. The truth is always more nuanced, more boring, more uncertain than either extreme suggests. Discipline means acting according to a predetermined plan regardless of current emotion. It means buying when you said you'd buy, selling when you said you'd sell, and doing nothing when your plan calls for patience. Most investors don't fail because of poor analysis. They fail because they abandon their plan during emotional moments. Write down your strategy before silver moves significantly in either direction. What percentage of your portfolio will it represent? At what price points will you consider adding? At what price points will you consider reducing? Having these decisions made intellectually before emotion enters the equation gives you something to reference when fear or greed takes over. Also recognize that you'll feel wrong sometimes. When silver is rising and everyone is celebrating, you might feel like you should have bought more. When silver is falling and pessimism dominates, you might feel foolish for holding. These feelings are normal. They're part of the experience. Successful investors feel the emotions but don't act on them. The title of this presentation mentions crisis. Let's be clear about what the real crisis is. It's not that silver might move dramatically in the next few days. It's not that you might miss an opportunity or take a loss. The real crisis is the gradual erosion of purchasing power that most people don't recognize until it's too late. It's the fact that working hard and saving money in traditional ways no longer guarantees financial security the way it did for previous generations. When inflation persistently outpaces wage growth and savings account returns, you're running on a treadmill that's slowly speeding up. You're working harder to maintain the same lifestyle, let alone improve it. This is the crisis, not the day-to-day volatility of markets, not the uncertainty around specific assets, but the structural reality that our monetary system is gradually redistributing wealth from savers to debtors, from prudent to leveraged, from those holding cash to those holding assets. Silver doesn't solve this crisis. No single asset does. But understanding the crisis helps you make better decisions about where to allocate resources. Assets that can't be printed, that have intrinsic demand, that have historically maintained purchasing power. These deserve consideration in a diversifying portfolio. Silver fits that description. So does gold, so does real estate, so do productive businesses. Each has different risk profiles and characteristics. The point isn't to go all in on silver. The point is to recognize that doing nothing, leaving all your capital in depreciating currency, is itself a decision with consequences. Many people feel paralyzed by financial complexity. They don't know what to do, so they do nothing. But doing nothing in an environment of currency debasement means accepting guaranteed loss of purchasing power. Taking action, even imperfect action, beats paralysis. Let's talk about time frames, because this is where most misunderstanding occurs. The title mentions the next 3 days. That's intentionally provocative to get your attention. But the reality is that nobody can tell you with certainty what will happen in 3 days. What we can discuss with more confidence is structural trends playing out over months and years. The next 3 days might see silver up 5%, down 5%, or flat. That's noise. What matters is whether the conditions that have historically preceded major silver moves are present, and they are. But present conditions doesn't mean guaranteed outcome in 72 hours. It means probability is shifted in favor of eventual repricing over a time frame measured in months or years, not days. Many people get this backwards. They want certainty about the short term, which nobody can provide. They ignore probability over the long term, which is actually where edge exists. If you're thinking about the next 3 days, you're speculating. If you're thinking about the next 3 years, you're investing. There's a profound difference. Speculation requires you to be right about timing and direction simultaneously. Investing requires you to be right about direction eventually, with patience, to withstand volatility. Silver is an investment, not a speculation. Treat it accordingly. This also means you can't expect this presentation to tell you exactly when to buy and when to sell for maximum profit. That's not how financial analysis works. We deal in probabilities, risk management, and pattern recognition. If someone offers you certainty about short-term movements in volatile assets, they're either lying or delusional. Professionals deal in probability and portfolio construction, not predictions. There's a crucial difference between preparation and prediction. Prediction means claiming to know the future. Preparation means positioning for multiple potential outcomes. We don't know if silver will rise substantially in the next week, month, or year. We know that structural conditions favor eventual repricing. We know that historical patterns suggest current positioning is attractive. We know that risk-reward appears favorable, but we don't know timing or magnitude with certainty. So we prepare. We allocate a reasonable portion of capital. We maintain perspective. We don't overextend. We don't abandon broader financial plans. We participate thoughtfully without letting any single position dominate our financial life. This is how professionals approach volatile opportunities. They prepare to benefit if they're right, but structure their involvement so they can survive being wrong or being early. Being early, entering a position that eventually works but takes longer than expected, is indistinguishable from being wrong in the short term. Many people give up on positions during this period, selling right before the move they anticipated finally occurs. Preparation means having enough conviction and appropriate position sizing to weather being early. It also means having realistic expectations. Silver might double over the next 2 years. It might stay flat for another year, then move dramatically. It might rise steadily without fireworks. All these outcomes are possible. Your preparation should account for all of them. Don't bet your financial future on one specific path. Diversification isn't admitting you don't know what will happen. It's acknowledging that uncertainty exists and positioning accordingly. That's wisdom, not weakness. We've covered substantial ground. Let's bring it together. Silver is at an inflection point driven by structural forces that have been building for years. Physical supply constraints, industrial demand growth, currency debasement concerns, and favorable technical positioning are converging simultaneously. This doesn't guarantee specific outcomes on specific timeframes. It shifts probability in favor of eventual repricing. If you already hold silver, maintain discipline and perspective. Don't let short-term volatility override your long-term thesis unless fundamental conditions change. If you're considering entry, understand what you're getting into. Silver is volatile, misunderstood, and inappropriate for short-term capital or conservative investors who can't tolerate drawdowns. But for those who understand its nature and can maintain patience, current conditions present a reasonable opportunity based on historical patterns. The biggest risks aren't silver moving against you temporarily. The risks are emotional decision-making, over-leveraging, abandoning your plan during volatility, or being paralyzed by uncertainty and doing nothing. The real crisis isn't what might happen to silver in 3 days. It's the gradual erosion of purchasing power that affects everyone who holds only depreciating currency in an era of unprecedented monetary expansion. Silver won't solve every financial challenge, but it represents one tool among many for protecting purchasing power and participating in potential repricing during specific market conditions. You don't need to do anything in the next 72 hours. You need to understand what's happening, make rational decisions based on your circumstances, and maintain discipline regardless of short-term noise. Markets reward patience and punish panic. They reward planning and punish emotional reaction. They reward those who understand cycles and punish those who chase momentum. If you take nothing else from this presentation, take this. Stay informed, stay disciplined, stay patient. Understand the structural dynamics driving markets. Position appropriately for your situation. Then let time and cycles do their work. The opportunity isn't in the next 3 days specifically. It's an understanding that we're in a period where traditional approaches to wealth preservation are insufficient, and thoughtful allocation to misunderstood assets makes structural sense. Whether you act on that understanding is your decision, but make it from a place of knowledge and discipline, not fear or greed. The next chapter of silver's story is being written now. Your role isn't to predict every twist. It's to position thoughtfully and respond wisely as events unfold. Stay informed, stay disciplined, stay thoughtful. That's how wealth is preserved and built over time, regardless of what any single asset does in any single week. Thank you for your attention. May your decisions be rational, your patience abundant, and your perspective long-term.